Welcome to Unit 8, Risk Management. In this lesson, lesson number 1, we're going to be talking about why risk management. Why is this topic so important? So important that Shay keeps on drilling in this topic in your brain really since the beginning of the Humble Trader Academy, since like Unit 1, Unit 2, and 3. So let's dive straight into it. Why risk management? From my own personal opinion and really from my own experience as a losing trader starting out day trading to slowly becoming profitable over time, risk management is really the only way forward to reach profitability, especially if you are a brand new trader to the market. You guys may remember my own story from Unit 2 where I talked about as a new trader, it always feels like I'm going one step forward with my profit and taking 3 steps back when I lose. And that's because of the lack of risk management. And I truly believe that risk management is the only difference between losing versus winning traders. Trading strategies are great and all, and yes, we are going to be talking about all the different strategies I use in a later units, but the reason they are in the later half of the Humble Trader Academy and not in the beginning is because risk management has to be the foundation. If you don't know how to manage your trades, manage your risk, and how to keep your losers small and your winners bigger, then I can give you any strategy or anyone else can teach you a strategy. You will never be profitable because you'll always be losing bigger than you make. Risk management is not a fun topic. It sounds dry. It sounds super boring. There's no Lamborghinis flying around here. But it's the most important foundation that you must have from the very beginning. So your day trading strategies or your setups allow traders to make money. But risk management is what's going to allow you to keep the money. It really doesn't matter if you make a lot of money in day trading, from day 1, day 2, day 3, if you just lose everything on day 4 and day 5. And that's exactly what happened when we have all these crazy stocks like GameStop, where it went from $40 all the way to $500. A lot of people made a lot of money because it was, quote, easy to make money when these kind of short squeezes happen on the way up. But most of those people keep on going back and coming back to the trade even when the stock is selling off from $400 down to $80, $40, and a lot lower. So this is always what happens. A lot of people make easy money on the way up, but without risk management, without, properly know how to, manage your losses versus your wins, and accepting losses is necessary. A lot of people just lose everything on the way down. And the same thing happens again over here when it went from $60 back to $300 and now it's back down to $140. Like I said before, you can be right 9 out of 10 times in trading in the stock market, but without proper risk management, one loss can blow up your entire account. And that's exactly what happened to me in my first year in trading. I'll be making small profits, $20, $50. A big win will be $100. And that's great and all. I'm slowly growing in my account. But it all takes one loss where I don't follow my rules, where I average down into my loser, or I start bag holding, and a small loss that should have been only $50 will turn into $100, $200, and $300 that will eventually blow my account. Successful and profitable day traders always think about the potential risk first, before even thinking about the profit. And you're gonna find that it's exactly the opposite with the losing traders who are struggling, and especially those who have blown up their accounts a couple of times in the past. Because they think about the opposite way. They always prioritize the profits, how much money they could be making if this trade goes in their favor. But what they neglect and they always fail to consider is the potential downside, the risk if the trade doesn't work in their favor. And that's the reason back in Unit 4, we talked about the concept of risk-reward ratio. And that's the reason we say risk-reward, because we think about risk first before reward and not reward risk. So here are some of the things that I think is very important to have in this risk before reward mindset. Most time it's more important to know what not to trade than what to trade. So obviously we're going to be talking more in depth about stock selection and how to pick out stocks that fit your criteria for trading in the later units, in the unit 10 to 16. But as a general rule, you should think about picking stocks kind of like dating. There should be tons of examples of red flags of different things that you know that you want to avoid. Essentially, if you see certain stocks have those red flags in your list, then you know that it's better to avoid them and to not trade them than try to analyze them, try to watch them, and try to figure them out. This is exactly like dating. I've learned my lessons. I know exactly what to avoid. So, very wise words from Humboldt Trader over here. Just kidding. You enrolled in this program to learn how to day trade, not to learn how to date. I should not be giving you dating lessons here. And also, of course, you want to be okay with missing out on those stocks that show those red flags. Again, we're going to be talking more in depth about what those kind of red flags look like in the later units when we talk about different strategies. This is a really good quote here, and I think it's one that's worth remembering for the future. It's always better to see a trade you wish you were in than one that you wish you weren't. Think about that. And also, as you gain more experience in trading and watching the stock market, you should start to listen to your intuition, your inside voice. And this is something that you'll develop after 6 months to a year into trading. Something like, I hope this works out. If you have to say hope in your head, then it's probably not going to work out, right? I'm here to teach you how to trade, how to analyze the stocks. I'm not here to teach you how to hope. And also, B, I probably shouldn't do this. Well, if you know you probably shouldn't do this, then just don't do it. And another good one is YOLO. If you think about YOLO in your head, it's probably a bad idea or a risky trade. YOLO stands for you only live once. So a lot of people will say YOLO and they go in on certain stocks and, that usually doesn't work out too well. Another way to think about YOLO is you only lose once because after that one loss, you're blown up. And this last one over here, I see other people are buying or selling the stock, so I should do the same too. And that's a terrible mentality in which you're just following other people blindly to buy or sell. And that's a terrible idea. A lot of times, like we talked about in, I think in unit 1 to 3 and my past experience, just following other people blindly into the trades, they will not work out. And it's not a long-term sustainable strategy. You are here enrolled in the Humboldt Trader Academy to learn how to think for yourself as a trader and to learn how to plan out your own trades. So that's the big difference here. I'm not teaching you how to follow other people. I'm teaching you how to make those plans yourself and become a self-sustaining, profitable day trader. And also, like we talked about previously, it's important to prepare a mental checklist of red flags when you are trading. So I hope this lesson gives you a good introduction into thinking about risk management and especially embracing the mindset of thinking about risk before reward. In the next lesson, lessons 2 and 3 of this unit 8, I'm going to be diving into the technicalities of how to calculate your own risk according to your account size and how to implement them as you are day trading. So I'll see you guys there.